The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren Ingram.
This is Pieter de Villiers.
And thank you very much for watching. We've got a lot to talk about today, and I'm going to let Pieter give you a bit of a background. But always just to say thank you. We appreciate your support, and also to Sealand. Thank you for the nice warm kit in this very cold winter. We appreciate it. So Pieter, we've got a lot to do, and we're launching a new series.
Yes, so we're going to try a similar approach this time as we did with estate planning, where we're going to have like a mini series where the purpose of this one is to talk about investment vehicles. So investment vehicle doesn't mean a bakkie or a polo. It means like, when I've selected my asset class combination, I've selected my funds, where do I put it? What type of wrapper do I put it around? And because it's quite an extensive topic to talk about, we're going to break it into 4 parts. So this episode, it's episode 1, I'm going to cover retirement funds. This now includes retirement annuities, pension funds, provident funds, preservation funds. Then next episode, we're going to cover tax-free savings accounts. And then the third episode, we're going to talk about normal discretionary investment accounts as well as endowments. And then the fourth episode, we're going to bring all of them together, and we're going to say, all right, so in which circumstances will you use which vehicle? And sometimes which combination of vehicles would make sense? And that's going to kind of tie everything together. So if this is the first time you're watching, well done. You're at episode 1. You're at the beginning of the journey. So just make sure that you stay tuned and subscribe so that you can watch the second, third, and fourth episode. And then hopefully at the end of this series, you'll be well equipped to know which vehicle to use and when to use it, and maybe which combination of vehicles to eventually take on.
And you might need a few vehicles for a few different kinds of terrain, I think.
Yes, yeah, exactly. Depending on how far you want to drive and how fast you want to get there and how much, let's say, toll fees you want to pay, going to depend on which vehicle you choose. So we'll also try and make it fun and make it applicable for you to remember.
I wouldn't mind people giving us a comment to say that if they want us to start the Honest Money car show.
Yeah, I think that would be fun. We're going to need some big sponsors there, but maybe we'll have a spin-off, who knows.
So retirement, let's say these retirement vehicles, just to talk about that a little bit as a broad category first. It always seems like when you talk to people that are in early stage of their career, I can almost watch their eyes like glazing over when you start to say, look, you really should contribute to your retirement fund, or and usually a little bit of a grudge purchase, I think, early on. My experience is very interesting, though. When you talk to those same people 15 or 20 years later, it's amazing how they are so impressed with how much their retirement funds have grown. And so maybe that's the first comment is, if you're watching and you're thinking, oh, come on, I've got 30 years to go to retirement or 25. Why are these guys talking about this? It is and will be one of the cornerstones of a great financial freedom plan. And not all retirement funds are bad. Not all retirement funds are expensive and useless. There are some excellent ones out there, and it's just knowing what to look for and how to choose the right one. So I think just to say in a kickoff, if you're not entertained within about 5 or 7 minutes, you're welcome to send me a rude comment. But I'm pretty sure you'll understand that this is really, I think these and that's why you've done it in the order. These and tax-frees are a crucial part of getting to a really great kind of financial freedom point.
Yeah, and what's important to understand, if you start out, you're investing for the long term. That doesn't only mean you're trying to get the best returns. You're also structuring your portfolio in a tax-efficient way, because there's a lot of stuff that we can't control. We can't control what the markets do. We can't control what inflation will be. What you can control is how much you invest, how much you earn, how much you spend, how much you invest, where you put your money, and how much taxes you pay. And unfortunately in South Africa, if we weigh all the taxes we pay together, we are probably one of the highest tax countries in the world per GDP. So we want to use these vehicles that the government tells us, hey, listen, we don't want to see you at your old age not having enough money and then you dependent on us as a government that's already struggling. So we'll give you some incentives to make sure that you provide for your future, and in doing so, will help you pay less taxes. So
Yeah.
it's one of the best ways to, you guys always say, I don't want to pay taxes. Okay, so here we give you now the best ways to save taxes, not only on the growth of your investments, but also in your estate. This is something that, again, if you're young, you're probably not thinking about, but you want to create a tax efficient estate as well one day. And if you were to pass away one day and you've got family, so that not a lot of that has to go to the taxman. And I think this is something that we sometimes see is as you say, like people start out, they don't want to hear anything about retirement funds, they don't care. But then they get closer to retirement and then you do a proper estate plan and you see, oh, I'm going to owe the government this amount. And then they want to start becoming more estate efficient. And then it might be a little bit too late or it becomes a bit more complex. So rather start out on the right foot and plan ahead, be proactive. And that's where retirement funds, with their pros and cons, becomes very important, a cornerstone of any financial portfolio.
So maybe just, I mean, I think we must get into the detail of each of the kinds of retirement funds, but I'd love to just highlight some summary points that are positive for all of them.
Yes.
So the one is you do get a very nice tax break when you put money in. And you're the better mathematician, so you can explain it, but also understand once the money's gone into the fund, all of the growth that you get on that money is free of income tax, and if you're paying income tax at 45%, that's a number. It's free of capital gains tax, it's free of dividends tax. So all of your growth going forward is tax free inside the fund. So you get a tax break putting the money in, tax free when you're growing it. On the way out, yes, you'll pay income tax, for example, if you decide that you're going to draw a pension from it, which makes sense. Well, it's called an annuity, but it's not on the whole capital base. It's only on the income that you're drawing out. So people get so fixated on I'm going to pay tax on the end, but not realizing that actually the compound effect of tax-free growth over the 20 or 30 years of putting the money in is enormous. And that little bit of tax that you pay on your income is, let's say you're drawing 500,000 Rand a year. It's income tax on 500,000 Rand, but you might have 30 million Rand retirement fund. And that's still growing while you're retired, tax-free. So I think that's important. The other thing used to be they limit my choices. I can't have enough money overseas. Well, let me just say, we've done a lot of back testing, both, I mean, me personally, but also if you listen to the fund management companies about trying to identify what's the ideal local versus offshore balance in a retirement fund, and even without a retirement fund, just in a pot of money. And guess what? It works out roughly at about 40 to 50%. Retirement funds allow you to go up to 45% overseas. So it's exactly midpoint of where a fund manager without any restrictions, if they just said, I'm going to grow a balanced portfolio for the next 50 years, they would probably average 45% offshore, and that's what you're allowed. And then the last thing is people didn't like the fact that you put money in and then you can't access any of it. And I think that was a valid concern, but that's not a valid concern anymore. Now government's created, I mean, I love these names, 2-pot and now 3-pot or whatever, but they've created ways for us to access some of the money that we put into our retirement funds. Equally, that they're forcing us to leave a portion of the money locked away until we retire. Now, if you think that's a bad thing, just trust me, it's a very good thing, because it means that at age 55, you're going to have a large lump sum. If you stay working and you go to age 65, even better. And so having a bit of access to your money through your career, I mean, if you have to do it, I don't like the idea, but if you have to, you can. But letting it compound and grow and then being able to draw later will be an absolute lifesaver for a lot of salaried South Africans. I mean, there are tragic cases where people would quit their job because they want to cash in their provident fund. So they get the money, they pay a third or half of it away to tax. They then use that money, usually just to settle credit cards or personal loans or something, and they don't have a job. Now that's what regulation is doing. Is it's stopping that really bad behavior. And you and I can stand on our heads and tell people that this is not a good thing to do, but some people do it anyway.
Yes.
So I think creating laws around it is really good. Yeah. But I mean, to me, I think there's and then you've touched on the estate. That was the last point, is moving money from me to my children and even to my children's children one day. I can do that inside a retirement fund without paying estate duty, which could be as high as 25%, if I remember correctly. That's for very big estates. Executors' fees, which could be 3.5% plus VAT, and then again, no delays in the process. You're not waiting for lawyers and the master's office and all of those things. It just happens here's the death certificate, there's the beneficiary nominations, a little bit of a process, and it happens. Yeah. So I think that it's a very good way to save. Probably wasn't as exciting 10 years ago in retirement. So there's a huge amount of pros, and I think we should kind of just get over that thing of not liking retirement funds. We're basing that on old information, and I think we need to just be clever about what we select, the costs, etc. But gee, like if you're resisting retirement funds for no real good reason anymore, you're doing yourself a huge disservice.
Yes, absolutely agree with all those points. And I think it's, if we look at the statistics of South Africa, and this is now based on studies that have repeated many years, only 6% of South Africans can retire comfortably.
Salary earning South Africans.
Salary earning, yes. So I mean, if you have a room of 16 people, it's one. Now, what does that mean? It means I've lived a certain standard of life, and now I retire and I continue with that standard of life. That's 6%. Now, that doesn't discriminate based on income. It doesn't discriminate based on profession. It's across the board. So even doctors, engineers, well-earning careers, they also form part of that. So one of the things that I think we also touch on a lot of times is when it comes to investing, there's the technical side and the knowledge and the skills and all of that you learn. And there's the behavioral side. And unfortunately, as humans, we make sometimes emotional knee-jerk reactions with our money that is devastating long-term. And we don't know that yet because we don't see that far. So one example, as you mentioned, is if I know that I'm drowning in debt and you know I need cash immediately. And it used to be like, if I quit my job, I get my provident fund, pay off my debt. Okay, clean slate. I feel better now. Or worse, I want to buy a new car, you know, where I'm going to get the money. Let me just quit my job, take the cash. What you're actually doing is you're robbing your future self, not only of that amount that you have invested, but the compound growth of that amount. And if you use that online calculators to see how much 1,000 or 10,000 or 100,000 over 30, 40 years, you'll get a big fright. It's millions that you're robbing yourself. So what we're trying to do, and what the government's doing with retirement funds, is protecting yourself from yourself, to say, listen, you need to commit to investing for your future, and we're going to put rules around this so that you don't go and mingle with it and destroy yourself. That's essentially what we're trying to do here. So yes, the money that you put into an RA or a retirement fund, we're going to touch on the different ones. They're very similar, but there are some minor differences. Is tax deductible. So the rules around that is either 27.5% of your taxable income. That's now your salary, bonuses, rental income, everything lumped together, or 350,000 Rand, the lesser one. So that means if you, let's say to make it very simple to understand, if you are in the 45% tax bracket and you put 100 Rand into the RA, you'll get about 45 Rand back in tax refund. It's a simplistic view. It depends on your taxable income, but that's kind of to understand. So not only do you get a nice refund from SARS, but now you've got extra cash you can reinvest in the RA, that refund. So you can kind of snowball the investment, or you can put that into a tax-free savings account, which is something we'll touch on next time. So that means we pay less tax today that we can reinvest. Important to reinvest and not go spend that money, because then you're really accelerating your wealth growth. And yes, it's true. If you retire, you're going to pay taxes. So it's more so tax deferred. But those many years of tax-free growth is going to be massive compounding effect in your favor. And the idea is, you know, if you are in a high tax bracket, so let's say 39% marginal tax bracket while you're working and you're contributing, chances are if you retire, you're going to be in a lower tax bracket, maybe 18% or 21 or 25%. So if you contribute and you get a tax deduction, and you one day pay taxes on a lower tax bracket, you're actually benefiting from that differential. So that's very powerful, especially if you progress in your career and your salary goes up. It becomes a very tax efficient way to benefit from that, even though you will pay taxes at the end. And estate planning, crucial. It's very important. So yes, if we look at the restrictions of RA, so this now means Regulation 28. So they tell us, right, we can invest up to 45% offshore, 75% equities, some other constraints as well. That does mean, yes, if you're going to compare two funds, let's say a tax-free savings account where you go 100% equities offshore, and the RA you go 75% equities, 45% offshore, yes, the tax-free will beat it over the long term, or a normal investment. That's just because of the high exposure. But when we look at an overall financial picture, it's not, we need to be careful, not just base information of just performance, because it also helps you to pay less taxes when you contribute. Falls outside of your state, which becomes crucial later on in life. And I think one other thing that I'll mention is, if you're an entrepreneur, your own businesses, there's a risk that something may go south, and creditors will come after you. And everything you have within a retirement fund is also protected from creditors. And that's good, because then they can't take that money. So you also building like a safety net that's protected from something going south in the future. Now, I think one of the big concerns of RAs, and understandably so, retirement funds, is they're expensive. If you go look at my EAC, it's 16%. It's invested in poor performing high fee funds. They still exist, policy-based investments. If you've been listening to this podcast for a while, you know that we both very much against those types of
really don't like
products. We wish they could just cease to exist, but you don't have to be invested in them. If you spend time and you look at your statements, you can transfer it to another platform that's low cost. If you go the DIY route, some RAs in passive funds, the EAC could be below 1%. So I agree, it shouldn't be on face value the reason that you don't want to invest in RAs, because you can actually, fees are very important to you. You can choose a passive fund in a low cost list linked investment service provider, and you'll save fees. And those funds actually also do quite well, giving between 9 and 11% over the long term.
Maybe the tip there is, if you're signing up for a retirement fund or an RA, and you see that there is an upfront fee, red flag. Just stop, walk away. Yeah. Secondly, if you are going to be penalized, or you're not able to transfer your RA from one company to another, so sometimes they'll charge you up to, I think, 30-40%. I've seen some of those. If you're going to pay a penalty to transfer your RA and you haven't started the investment, don't do it. Those are, to me, the very, very easy ways to say, I'm in the wrong thing.
Yeah.
After that, so once you've ticked those two boxes, then you look at the effective annual charges and say, okay, what am I paying? Is it fair cost? What am I getting for it? And always, because you are able to transfer and you don't pay tax on those transfers, if you've made a bit of a mistake, or the industry evolves quite quickly. So you might find that today the benchmark is an effective annual charge of 1.5%, and in 3 years' time there are new competitors that are doing it at 1%, and then 5 years' time there's people doing it at 0.5%. If you're not stuck in a contract where you pay penalties, you're able to transfer. So this isn't a one and done for life decision, and I think that's the other thing. So don't pay upfront fees, don't get locked in. There are no real good reasons there not to do this.
Yeah.
And I'm going to challenge you a little bit. We talk about the Regulation 28, which says 75% in shares. Okay, cool. But add to the fact that you can, in a portfolio like that, especially where you're including global assets, you can add property companies as well. And so actually your exposure to very high growth assets goes up to about 90%, if I remember correctly. It's high. And actually a balanced portfolio over a 2 or 3 decade period where you're at maximum exposure to shares and property companies, if you look at the benefit of a little bit of cash, a little bit of government bonds, both local and overseas, it's going to be really close to what the index could give you, a global index. But actually the ride is a little bit smoother. The peak and the trough is a bit better. So for your sanity, you want to get to retirement, and you also still want to be sane. And so I think actually a lot of the time, very high exposure to shares inside Regulation 28 environment, probably the best vehicle for most of us, because it's not just about the number. Like, you're right. So world equity does better than a balanced fund, fine. But actually the ride that world equity does, or local equity does, causes most people to make behavioral issues. And or they end up in the funny farm, right? So no, I'm not saying that. But they end up with a lot of stress. And so if you get a bit of a smoother ride, then I think that you're more likely to stay invested, less likely to make mistakes. So I mean, you're right. It isn't always just about numbers. It's also about our behavior and managing ourselves in a way. So government's doing some stuff around rules, which I actually agree with for once. I don't often agree with government. And then 2, we've got to say to ourselves, we're not sacrificing growth if we're going to stay invested.
Yes.
We sacrifice growth by selling out at the worst time. And I think that's a bigger behavioral mistake to me.
Yeah. There's one study from, I believe it's Vanguard, I'm speaking under correction here, where they did studies on how most people perform, what the actual returns are.
Oh,
like DIY.
The behavior gap.
Yes. Yeah. And you can correct me if I'm wrong, but I think it's the actual returns of most investors are actually like 3%. And that's not because they chose poor funds, it's because they made mistakes. When the markets go up, they've got FOMO, they want to buy at the top, and the markets drop, they get scared, they sell, and their effective return is actually like 3%. If we expand on that, there's another study that was done on the S&P 500. I think it was between 2002 and 2022, so over 20 years, if you remained invested, you'll get about 9.7% in dollars in the S&P 500 over that term. But if you only miss the top 10 days, and this is now over like thousands of days, your return will drop to 4%. So from 9.7 to 4%, just missing 10 days in over 7,000 days. So that's what we're driving home is oftentimes we are our biggest enemies. And when we do create investments, we automate it and we forget about it. Building wealth long term is the rich life is almost slow and boring and just keeping with the plan. But in any case, let's go back to the retirement funds. Just one more thing on the offshore exposure. So yes, it's true that 45% is limited to offshore, and what that means on a fund level is the companies need to be registered in South Africa. That's just what that means. But some companies are dual listed, South Africa and maybe London Stock Exchange. And many of our South African companies actually earn overseas. So I think that 45% offshore is actually more if we go effectively look at dual listed companies and companies earning from overseas, and it could maybe more close to 60 or 70. So then also let that scare you off. I'm like, no, but the government's trying to, I have to invest everything in Eskom. No, it's not. It's not true. You can still have, and some South African companies do well, and it's a local environment that you are living in and spending in. So it makes sense to have concentration to South African companies. So now we've kind of covered the broad aspects of retirement funds, and now we get 4 different ones. We get a retirement annuity, pension fund, provident fund, preservation fund. So I'll start off with a retirement annuity because I think that's what most people are aware. This is now where you create your own personal pension. So you don't belong to an employer, or you want to kind of top up what you're already doing through an employer. So a retirement annuity, the rules around that is you can invest up to that limit that I said. You can invest more than that, but it's going to be tax deductible, so it will roll over to the next year. There's no penalties to over contributions to a retirement fund, luckily. It's got the same rules that we've explained so far. And it used to be that you can only access it at the age of 55. With the new 2-pot system, how that works is everything up until the 31st of August 2024 has those rules that it always was. But from the 1st September 2024, every contribution that you make to an RA gets split into 2 pots. So we've got the savings pot, that's 1/3 of the amount, and that you can access once a year. So you can actually withdraw that. That's taxed according to your marginal tax bracket, like you would your income. And then 2/3 of that contribution goes to retirement pot. Can't touch that. That's going to remain there until at least 55, after which you can then decide to buy a living or a life annuity. So RA is simple. You can do it yourself through one of the many platforms available. And that is what you will do in your personal capacity.
And I think for a lot of self-employed people and contract workers and gig workers, it's very attractive. And remember that if you choose the right RA, it means you don't have to commit to a monthly debit order.
Yeah.
For example, I mean, if your cash flow is predictable, that's the better way to do it. But if you work in gigs or you get lumpy income, you might decide every January before the end of the tax year to say, okay, I've got enough lump sum saved up. I am disciplined enough to do it, and I'm going to do a contribution. So you're not stuck in that thing. But I mean, it's a fantastic vehicle for most of us to have. And very rare that your company retirement fund uses up your full maximum allowance of what you could contribute. So then saying, well, okay, 20% is going of my salary to my company retirement fund. The balance, I've listened to these honest money people. I'm going to do a top up and get the maximum benefit that way. I think it's kind of a no-brainer.
Yeah. And if you are very concerned about the future of South Africa, because some are, then if you do immigrate one day, you can still access the money in your RA after 3 years of immigration, formal immigration. So that means that, yes, the money would be tied for those 3 years, and you can't just take it now because you need to find your move, plan ahead for that, but it doesn't keep you locked in for the long term. So if you are young, you're uncertain, kind of 50-50, an RA would make sense, I would say. Yeah. Unless you are for sure know that next 5 years I'm out, then probably not going to make sense. Rather keep the money liquid because you're going to invest it overseas in any case. But for most other people, it's a great tool. Then we get the RA version of an employer. So you join a company, they've got a company pension or provident fund. Pension or provident fund is basically the same thing now. It used to be different. There's like retirement reforms. If you have to go study every couple of years, they change stuff, and you have to remember
It's just to sell textbooks.
just to make my studies complicated. I'm busy with now. But any case, to keep it simple, it's the same thing. So you're part of an employer, so they say, all right, cool, Peter, you join our company, so we're going to take 5% of your salary as an employer, and we're going to contribute it to your pension or provident fund. And then you can also match that at 5%, or you can even increase it sometimes. So then what's nice about that is they've got a corporate pension fund that's with one of the big providers. And usually those funds tend to do quite well because they've got economies of scale. They've got a lot of, if you're a big company, a lot of people investing at the same time, fees are lower. It's good to go look at the available funds and choose one that's appropriate to you, because you have the option most of the time. And I think the benefit of that is really when you get your salary every month, those things get deducted. You don't even see that. So you just get your net salary and your retirement is taken care of. And if you can, between you and your employer, invest that 15% per month into retirement, you're already putting yourself far ahead for the future just by paying yourself first instead of cashing it out. And it used to be that if you leave your employer, you could cash out that full amount of both. But now with the two-pot system, it follows the same rules as RA. So 1/3 goes to a savings pot that you can access. 2/3 goes to retirement pot. You can't take that. But up until the 31st of August, the same rules apply as it used to be. That is when you're part of an employer.
Maybe just there to say that I think, the savings pot, you in your mind when you're making this contribution, you should be saying, this is not money I'm ever going to touch. I'm going to touch it when I retire.
Yeah.
So it's got a name. It's called savings, but this is not the holiday fund or the handbag fund or the new shoe fund. It's for your retirement. Yes. So the only reason that you ever access money like that is because you're in an absolute desperate state. You can't feed your family. You're about to get kicked out of your house, something like that. Then maybe that's when you call on it. But for everything else, make another plan. And so it's there. It's available. It's a nice facility to have as a peace of mind factor. But people are looking at this and saying, great, I'm going to just, every year I'm going to take a withdrawal from this. You're really hurting yourself. So it's not good enough to contribute 15% and then draw out of your savings every year. It doesn't help. So it's better than nothing. But and so I'm not critical of the legislation, but I just think we should just be really careful. And you pay so much tax when you take that money out. So you're giving away a lot. And a lot of people who did this right at the start when two-pot was implemented, they did a withdrawal from their retirement fund and all of the money went to SARS because they owed SARS money. So just know that if you owe SARS money and you take money out of a savings pot, SARS gets the first bite of it and it could be everything. And nothing's gone wrong. They're not doing anything wrong. You owed them the money and now they've taken it.
Yeah, that was probably a big surprise for many people. Like, yes, I now have free money. And then whoop, you get nothing because you owe SARS. So if you like SARS and you like giving away money to the government, sure, take that savings. If you don't like that, I always tell people if they ask me about the two-pot, I'll explain how this works. And I've got a more comprehensive video on my Money Marks channel that does the deep dive into it. But for all intents and purposes, forget that it exists. Continue investing and forget that you have access to those savings, because it really only in those dire situations where there's no other outcome, then maybe. But at least now you don't have to quit your job to take that. So I think that's it's a short-term kind of pain for long-term gain. And I do see the future of retirement stats looking better because of this change, because most people need that kind of automation of providing for their future selves unless they...
If we're sitting here in 10 or 15 years' time still recording these, then we can say, look, we told you. Look how much better everything is now.
2025, I told you. And then the last thing is a preservation fund. So let's now say you're part of an employer. For some reason, you decide to leave. Either you take on a new job or you quit or you resign or you get dismissed. What do you do with that pension fund? So pension or provident fund. So you've got three choices. or you used to have 3 choices. The one was you cash it out. That doesn't exist anymore. Second one is you can keep it with the current employer that you were with, and they'll just put it into like their own preservation fund within the company, and it will be invested the same way, same fees. Third option is transferring it to another company's pension fund or to a preservation fund. So a preservation fund, all that means is we preserve. So you've built up your pension fund, now transfer it to a preservation fund, has the same rules as all the other retirement funds. Regulation 75 and all of the regulations 25, 75% equities. And now that money can continue grow tax-free until retirement, where you then can take that 2/3 out and invest in a living or life annuity. So it's a way to preserve what you've built up, and you can do it through most platforms as well. It's a fairly, we call it a Section 14 transfer that you have to just take it across. Legislation allows that to take 6 months, and sometimes it does take 6 months. It's a bit of an onerous process with the admin, but you preserve your money. Now, it's important to note you can't now, let's say you moved it to another platform, you can't now contribute like a debit order to that. You can only add pension and provident funds in the future to that preservation fund. But then, if you want to add more, you can just start a retirement annuity. So it's just in the name, it preserves.
And at the end, when you decide to retire one day, you can consolidate all of those things into one living annuity if you want. So it's not like you're going to have 15 different investments if you've changed jobs 15 times over your career. You can end up having quite a simple deal. So going to correct one thing. It's Reg 28. So
sorry,
75%. And I know this.
Messing with my mind tonight. So don't have enough coffee.
So I think we're about to break our record. So we're going to have to wrap it up there, Peter. But I think it is a series, and we're covering it very nicely in terms of what investments you can make, but also at the beginning, I think just that again, just listen to what we said there, because actually there's a lot of value in these things, and I think a lot of the time they're undersold.
Yes. What's important is understanding the rules and understanding the rules of the game. Don't get caught up in those expensive RAs. We don't like them at all. And sometimes you can transfer it out. Sometimes there's penalties. We're not going to go into that deep today, but understand that retirement annuities or retirement funds overall plays a very important cornerstone of any financial plan now and in the future. And unless you know for certain you want to immigrate, I'd say it makes sense for most people. So this is the first episode of the 4-episode series. Next up, we're going to cover tax-free savings account in the next episode. So we'll launch that next week. And then after that, discretionary funds with endowments. And then the 4th episode, we're going to bring them all together and maybe do like a fun case study of where, if we were to earn this amount, how would we kind of disperse it between the 4 so that it becomes easier for you to remember and to apply.
Thank you so much for watching. We look forward to chatting to you in the next episode.
Thank you. Have a nice day.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.